Banks are bracing for a mortgage renewal disaster. And if you locked into your mortgage during the pandemic, it's time to understand just how serious this could get. In this video, I'll break down what's going on behind the scenes, why it matters, and what you can do to stay ahead of it. Because in the end, banks are doing what's best for them, protecting themselves. The real question is, are you doing the same? Hey, I'm Justin Chaussee, a mortgage broker working with Canadians across the country, and here's what I'm seeing more and more of. People who bought between 2020 and 2022, when rates were ultra low, but home prices were sky high, are now facing renewals that could see their mortgage payments increase by hundreds of dollars per month. During those early pandemic years, the average home price across Canada skyrocketed. In places like Fraser Valley in BC, prices jumped over 70%, while the GTA, we saw increases close to 60%. It was the wildest run-up I've ever seen. But what's about to happen next? The headlines are calling it a renewal cliff. In reality, it's a slow motion reset, and it's already underway. In this video, I'm going to walk you through exactly why the banks are concerned, what you need to know if your renewal is coming up, and the steps that you can take now to protect yourself and your home. So what is the mortgage renewal disaster? During the pandemic, interest rates dropped to a historic low. Fixed rates below 2%, variable rates which felt like free money. Canadians locked in, often for 5 years, and didn't think twice. And trust me, I don't blame them. Now those mortgages are coming up for renewal, which means that 5 years is up and they need to renegotiate their mortgage rate with their existing and or new lender. And the rates have nearly tripled. That means monthly payments could rise by hundreds, even thousands, depending on the size of your mortgage. It's not a cliff that you actually fall off. It's more like a slow squeeze, and it's already putting pressure on families from coast to coast. But rising rates aren't the only problem. Here's what I call the perfect storm. From 2020 to 2022, homes were selling at an all-time high. In Hamilton, Burlington alone, prices rose nearly 80%, adding almost $500,000 to the average home. Many people paid top dollar, and now appraisals are coming in lower than what they originally paid for the home 5 years ago. That's a serious issue if you want to refinance or switch lenders. Then there's the static variable crowd. Their payments didn't change, but the interest portion did, and it changed a lot. Now some homeowners are in what they're calling a 99-year amortization, which, let's be real, is just a fancy, slightly rude way of saying that that you're only paying interest. The bank's not going to tell you that directly, but that's the reality. To fix it, you'll need to bring your amortization down from 99 years to something closer to 30 years. And that's the real kicker. It's not just the rate increase that hurts, it's the fact that you're now compressing your payments into a much shorter timeline. That's what makes the monthly payment jump up so dramatically. You're not just paying more interest, you're actually being forced to catch up on the years of unpaid principal fast. Banks know what's coming. They're padding their just-in-case funds, what they call their loan loss preventions. That money they set aside in case people start missing mortgage payments or defaulting altogether. At the same time, they're tightening up the approval process. Yes, they're offering things like extended amortizations to soften the payment shock. Behind the scenes, they're combing through every application with a fine-tooth comb, especially if your home isn't worth what you paid for it a few years ago. And this, my friends, is how the banks are trying to reduce the number of people defaulting on their mortgage over the next few years. Because like I said earlier, they're in the business of protecting their bottom line. Their job is to make money for them, not you. To make things even more unpredictable, no one really agrees on where the economy is heading. Inflation cooling, but not enough to bring rates down in a meaningful way. There's a housing shortage, but homes are still unaffordable for a lot of Canadians. Some experts say we're headed in for a crash, and others say we'll level off. And on top of all that, the political chaos south of the border is shaking up the global markets. When things get unstable in the US, it sends a ripple effect through our economy too, especially when it comes to investors' confidence and interest rates. But here's what we do know. Rates are high, renewals are coming, and mortgage payments are going up. That's not a prediction, that's just math, and that's really where we're living today. This isn't just a big city Toronto or Vancouver thing. Sure, those markets will feel the most dollar for dollar pressure, but this is happening nationwide, even in smaller markets like the Maritimes and Alberta. People who are getting squeezed if their income hasn't grown alongside their housing costs. The national stress test applies to everyone, no matter where you live. And it's not just the stress tests. Mortgage rules in Canada are typically national. Interest rates, lending guidelines, minimum down payment rules, and qualification standards are set at the federal level. That means whether you're in downtown Toronto or rural Saskatchewan, you're playing by the same rules. So even if home prices in your area are lower, that doesn't mean it's easy to qualify. Your income, your debt, your credit, it's all measured against the same national bar. And as rates rise, the bar keeps getting harder to clear. So what can you do? Know your renewal date. Don't wait for the bank to reach out. Understand your numbers. What's your rate, the balance, the amortization, and the equity that you have in your property. Run the options early. You may be able to refinance, restructure your mortgage, or tap into an equity with a home equity line of credit known as a HELOC. Check your static variable. If you're not paying off any principal, it's time to talk, like right now. This is where I can help. We'll map it all out with real numbers and no more guesswork. The first step is figuring out how much equity you have, because equity equals options. I've got access to some tools realtors use to get real-time valuations of your home. Once we know what it's worth, we can break down your equity and figure out your smartest next move. Whether that's refinancing, accessing funds, or just lowering your risk exposure. Just by clicking the link below or sending me a message, there's absolutely no pressure. And if this helps, hit the subscribe button. I post weekly videos about what's really happening in the Canadian real estate, beyond what you're reading in the headlines.